and welcome to Morningstar. I'm Emma Wall and I'm joined today by Chris Rice from Sanderton Asset Management. Hello, Chris.
Hello.
So you seem to be the bearer of bad news for investors. How bad is it?
Well, in some respects, actually, the corporate cycle is fairly normal. We've had effectively the third longest bull market in American history. So you would think things were actually quite fine. And actually, corporate profits in America are at their previous peak. So in pure cycle terms, everything's fairly normal. What's different this time around in this particular cycle has been the extraordinary intervention in financial asset markets by our central banks. So if you look at the whole swathe of financial assets, cash is currently yielding a negative return because inflation is higher than the deposit rates you can get. 85% of bond markets yield less than the US 10-year, which yields 1.7. The median price earnings ratio in Europe is 20 times earnings. It's the same in the United States. And property is virtually only affordable for those with enough money to transfer to their children. So the vast majority of financial assets are incredibly low yielding because of the intervention by our central banks. And after 7 years of that process, we should have been withdrawing it. My bearishness comes more from the fact that asset prices are high in relation to what has been a fairly normal business cycle.
Of course, what's happened is this intervention has meant that investing 101 has broken down. Diversification is not possible. Normally, equities, or the rule book says, equities do well, bonds do badly. Bonds do well, equities do badly. But what you've just told us is there's literally nowhere to run, or so it seems, because everywhere is looking toppy.
Well, there's an element of truth in that. And when you get to the end of these sort of very long cycles where yields get incredibly low, the financial history books tell us that in real terms we start to lose money. Now, the major sort of example from history we have to look back to is the 1970s. Now, of course, in that period, they managed to engineer inflation, which is one way of solving for the fact that a numerator and a denominator are too far away from each other. So there are many outcomes that I don't know of, and I suspect a lot of other fund managers and investors don't quite know how it's going to play out. What we can observe is there's just really poor value. And on your point of correlation, it's a really important one, because the one correlation that actually has worked up until recently has been equity bonds. Within equities, it's been very hard to get anti-correlation. Within bonds, it's been quite hard to get that diversification benefit. But reliably, we've had this situation where typically you've had a pullback in equities, bond yields have fallen, and therefore you've been able to counterbalance the two. Since the end of US QE, that's started to break down. You've found typically sometimes both can go down at the same time. So that's why I said in my presentation, I think that in the first line of defence, as we go from a slowdown into a recession, I think the first line of defence has to be cash. We do run a long-short portfolio, and we have said to our clients for some years now that the likely way of defending yourself in a long-short portfolio, if you can, is to go net short the market. And that would be another way of seeking protection.
So it's not all doom and gloom. There are ways for investors to, at the very least, get capital preservation in these uncertain times ahead.
Yes, I think that's right, absolutely.
Chris, thank you very much.
You're welcome, thank you.
This is Emma Wall from Morningstar. Thank you for watching.